Quiz 5, question 9. The price of IBM stock on the 2nd of January was $153.31, and on the 1st of May, the price of IBM was $172.28. A call option on IBM maturing on the 1st of May with an exercise price of $160 was traded on January 2nd at a price of $780. What is your profit from holding this option? So what this means is, in January, someone bought a call option, and that call option gives them the right to buy shares of IBM for $160 on May 1st in the future. So considering the price went up to $172, buying at $160 is rather attractive. So first what we want to do is calculate the profit from the option. And the way that we do that is the option could either expire in the money, at the money, or out of the money. In this case, this option is in the money because you can exercise at a price less than the market price. If the option was at the money, that would mean the exercise price would be the same as the price in the marketplace. And if the option's out of the money, that would mean the call is at an exercise price greater than the price of the underlying asset, which is IBM stock on March 1st or May 1st. So our function that we'll use here is max. We want to take the max of two states. So either 0 is going to be the highest value, and that would be the case if our option is at the money or out of the money. Otherwise, we'll have a situation where we're comparing the option price relative to the stock price. So we'll take B4 or E4 less E6. But what we also then have to do is back out for the cost of our option, which is in E7. So what this statement is telling us, we're either going to have a max of two states, either 0 or E4 minus E6. So for instance, notice here, because E4 is greater than E6, we have an output of 1228. But what if this amount was 155? If it's 155, what that means is 155 minus 160 is -5. So 0 is the largest amount. We get a dash here just because we're in accounting text. But if we change this to number, you'll be able to see that it's a 0. Next, we need to account for the cost of the option, which is we need to back out the 780. What this is saying is, if we bought the option, but it expired worthless, we would still have to calculate in the cost of the option. So again, if we change this from 172 to 155, we could see that we're out $7.88 for the cost of the option. So we see by buying the option, we're $4.48 ahead per share. We then want to calculate our percentage of profit. Now notice our profit is relative to how much we bought the option for, not the price of the stock. So we made $4.48, and then we want to divide by the cost of the option. So we can see on our 780, we made $4.48, which reflects a 57% rate of return or percentage profit.